Hello children, hope you are keeping safe. Okay, we'll move on to the lesson. This is your first lesson of the third midterm, lesson number 31. It is fiscal policy and SOW references page number 250 to 258. Content in this lesson: policy instruments. What is fiscal policy? Government revenue, government expenditure, fiscal deficit and fiscal surpluses, impact of fiscal deficit and fiscal surpluses, the impact of fiscal policy on macroeconomic objectives. What is fiscal policy? Fiscal policy refers to government spending and taxation policies intended to maintain economic stability. Therefore, the government will use a policy instrument in order to achieve macroeconomic objectives. What is a policy instrument? A policy instrument is an individual economic tool which can be used to manipulate an economic variable to achieve macroeconomic objectives. Now, what are variables? Variables are rate of interest, rate of taxation, and level of government expenditure. There are some other variables in the economy, but these variables generally can be found in an economy. When the government changes these variables directly or indirectly, it can be affected other variables. What are the other variables means here? That means macroeconomic objectives. What is macroeconomic objectives? Aggregate demand, decreasing inflation, decreasing unemployment, increase GDP in the country, and some other objectives can be found in an economy. For an example, if the government increases income tax, what would happen to the disposable income? The disposable income will fall. As a result, aggregate demand also will fall. It means if the government has an objective to increase the aggregate demand in the country, because of the interest rate, the aggregate demand can be decreased. That is what it says here. When the variables uses as an instrument used in the policy, it can be impacted macroeconomic objectives. Now we'll see how interest rate can be impacted the macroeconomic objectives. Interest rate have an impact on everything from home mortgage price to the ability of businesses to expand through financing. If the interest rate go too high or are pushed higher than what people and companies can readily afford, spending could stop. In this sense, higher interest rates could mean that a person may not be able to get a loan to purchase a house on favorable terms, or that a company will lay workers off instead of financing payroll during a downturn. So it means again, when the country needs to decrease the unemployment because of the rate of interest, what would happen? Again, returning back to the higher unemployment rate. Tools of fiscal policy can be summarized according to the structure that you all can see here. Tools of fiscal policy can be divided into two: public revenue and public expenditure. Public revenue, you all know that it is accumulated through taxation. Taxes also can be divided into two: direct taxes and indirect taxes. And public expenditure includes mandatory expenditure and discretionary expenditure. In the other slides, you all can learn in detail about government expenditure and taxes. Children, you all have learned that the main source of revenue for a government is taxation. Why does a government use taxation to accumulate revenue? That is to pay for public sector services. What are the public sector services? Health, education, transportation, and some other services. To improve the public sector services, government needs revenue. That is why government collect tax from the goods and services. And also to discourage certain activities. What are the activities will be discouraged by the government? In some countries, taxes are imposed on cigarettes and discourage smoking because it is dangerous. And there is also a tax on dumping rubbish in landfill sites. Unlike in Sri Lanka, the other countries, especially like in UK, they impose taxes or fine for dumping rubbish in the landfill sites. That is to encourage everyone to reduce waste. And also taxes can be used to help to control aggregate demand in the economy. How aggregate demand can be controlled? Using taxation. That is, if the government increases taxes on goods and services, the price of the goods and services can be increased. It means the consumer demand also will fall for goods and services in the economy. The distribution of wealth in the economy can be made failure. This is you all have discussed in the chapter 30, page number 240 to 249. Again, you all can read the chapter 30 in order to emphasize about the distribution of wealth. Children, you all know that a government will accumulate its revenue through taxations. Even in the structure you all saw, the government revenue consists of two types of taxes. What are they? Direct taxes and indirect taxes. Here are some examples for direct taxes. Income tax is one of that. It means the tax imposed on the amount earned by an individual. It can be employed or self-employed individuals. Social insurance taxes means the tax that imposed on people's income and that can be used for pensions and healthcare. Corporation taxes means the tax that imposed on profits made by limited companies such as partnership and sole traders. Capital gains taxes levied on financial gain from assets. And inheritance taxes means the tax paid on money that is inherited from people who die. The other type of tax is indirect taxes. Here are some examples for indirect taxes. You also can read sales taxes, duties, custom duties, council taxes, business rates and stamp duties. You all know about VAT. That means value added taxes. It is imposed on consumer goods. In some countries, they have a standard percentage. For an example, in Denmark, it is 25%. Duties are often heavy taxes. They are imposed on petrol, cigarettes, and alcohol. Type of goods have price inelastic demand. It means when a changing price causes a smaller percentage changing demand. When the price increases, the demand for petrol will change a smaller amount because petrol needed for vehicles. Even for medicine or the cigarettes, if they addicted or used, they need even the price is increased. Custom duties are taxes levied on imports. In the UK, goods coming in from a country that is not member of the EU attract custom duties. Council taxes is collected by local authorities to help pay for local services such as refuse collections. Business taxes are also collected by local authorities and contribute to the provision of local community services. Stamp duties are paid when buying certain assets such as house and shares. Children, it is important to learn about environmental taxes because a country like Sri Lanka needs this type of taxes in order to protect the environment, whereas Sri Lankan government doesn't use environmental taxes. In some other countries, they use these type of taxes in order to protect the environment as well as the atmosphere of that country. Landfill tax is imposed on disposal of waste in landfill site. The charge is usually linked to the weight of waste dumped in the landfill site. Climate change levies are used to help countries meet their commitment to reducing greenhouse gases. Aggregate levies is a tax on sand, gravel, and rock and dug from the ground or extracted from the ground. The tax is designed to reduce the environmental damage caused by quarrying. Children, Now we will find out what government spending is. There are two types of spending: mandatory spending and discretionary spending. Mandatory spending means it determined by the current system. Example, when someone is made redundant, they are entitled to claim job seekers allowances. Whereas discretionary spending means extra or new spending. For example, money provided for a new motorway. Children, now we will learn the difference between fiscal deficit and the fiscal surpluses. How fiscal deficit can be occurred in an economy. A government creates a fiscal deficit by spending more money than it takes in from taxes and other revenues, excluding debt. The gap between income and spending is closed by a government borrowing. Do you know the budget deficit in Sri Lanka in 2019? It's minus 6.8%. However, this money might be borrowed from both domestic and foreign banks and possibly other governments. Whereas fiscal surplus means a government runs a budget surplus when a total tax revenue exceeds government spending in any given year. This is also known as fiscal surplus or budget surplus. Both gives the same meaning. What might cause a budget surplus? Strong tax revenue or economic growth, isn't it? This is an example for fiscal and debt indicators in selected countries in 2019. According to the graph, you all can see fiscal balance and public debt. These are the fiscal balance. You all can see these bars are represents or indicates the fiscal balance in countries. What are the countries? Argentina, Brazil, Colombia, Chile, Mexico and Peru. In Argentina, compared to the other countries, Argentina has 88.0% of public debt and minus 3.8% of fiscal balance. But in Brazil, the public debt is 75.8 and the fiscal balance is minus 5.9. That means Brazil has some amount of fiscal balance than Argentina. When you compare Mexico and Peru, both the countries have minus 1.6% of fiscal balance. You all can see here, it indicates minus 1.6 fiscal balance of Mexico, and Peru also has the same amount of fiscal balance, that is minus 1.6. But the Argentina has the highest public debt in comparison to the other countries. This graph shows the average spending since 1984 to 2018 and average revenue since 1984 to 2018 in Sri Lanka. According to this graph, you all can see the blue line indicates the average revenue, whereas the red line indicates the average spending. In 1999, you all can see there is a increase in average revenue than average spending. Since then, there is a decline in the revenue, whereas the spending has been increased drastically in 2019. Since then, there is a decline, but still it is greater than average revenue. That is because the structural mismatch between spending and revenue in Sri Lanka. Impact of a fiscal deficit. When the government plans to overspend, it will have to borrow money to fund the deficit. As a result, if deficit built up over a period of time, the national debt will increase. This means that the government has to spend more and more of its revenue on paying off the debt. And also, fiscal deficit will be a burden for future generation. It is best to express the deficit as a percentage of GDP because that gives a clear picture of how government is contributing to the country's economy in general. Impact of fiscal surplus means it can spend number of ways. If you have the surplus in the country, the government can spend more to the welfare of the society. And also, if there is a fiscal surpluses, then the government can reduce the taxes in the economy. And also, the government is able to pay off the national debt. Children, a country will use contractional fiscal policy in order to slow down the economic growth, especially at an inflationary situation. The government will use the tax as a tool under this policy in order to reduce disposable income of consumers. It means the income tax or the sales tax can be increased. As a result, the consumers' demand can be decreased. Similarly, because of the taxes, the producer cost of production also can be increased. As a result, producers will try to reduce the cost of production. To do this, the producers will decrease the investment in projects or expansion in their production. It may lead to a redundancy of workers. As a result, aggregate demand can be decreased and also the inflation can be controlled in the economy. In contrast, expansionary fiscal policy will be used in order to boost the economic growth. That means the government will try to expand the money supply in the economy using budgetary tools to either increase spending or cut taxes, both of which provide consumers and businesses with more money to spend. The purpose of expansionary fiscal policy, as I said earlier, to boost growth to healthy economic level, which is needed during the contractionary phase of the business cycle. The government wants to reduce unemployment, increasing consumer demand and avoid recession. The two major examples of expansionary fiscal policy are tax cut and increased government spending. Both of these policies are intended to increase aggregate demand while contributing to deficit or drawing down the budget surpluses. Children, you have learned two types of fiscal policies. One is expansionary policy, the other one is contractionary policies. Hope you all could understand the differences between that two policies. Expansionary policy is concerned it boosting the economic growth, whereas contractional policy will reduce the economic growth in order to control the inflationary situation in the country. In this picture, you all can see clearly expansionary policy increasing government spending and decreasing taxes in order to encourage the consumers and the producers in the country. Whereas under contractional policy, the government will reduce the spending and increase the taxes in order to reduce the aggregate demand and aggregate supply in the country. It means expansionary policy increases the inflationary situation, whereas the contractionary fiscal policy controls the inflationary situation. If you could understand the contents of this lesson, you will be able to suggest a policy for the variables and the macroeconomic objectives to say that this policy is suitable, why it is suitable, and how will it work in an economy. Economists say that contractionary policy brings down the inflationary pressure. Using this policy, a government could cut its expenditure and raise taxes to reduce aggregate demand and aggregate supply in the country. As a result, the inflationary pressure can come down. Again, what will happen to the policies when a government wants to achieve an economic growth in the country? The government should turn the spinner to the anti-clockwise. Why? To increase government expenditure and cut taxes. It means the government needs to increase aggregate demand and aggregate supply in the country to come to the boost stage on the business cycle, achieve an economic growth. At the same time, the unemployment can be reduced as the government expenditure increases on construction projects. What are the new projects that the Sri Lankan government started in the recent years? New motorways, port city. Which policy will be suitable to reduce the current account deficit? Contractionary policy. Why and how? Because it helps to reduce imports and encourage domestic goods and services to consume. A government needs both policies to solve the environmental problems. Why? That is because expansionary policy provides substitutes to the producers to encourage activities that are environmentally friendly. At the same time, taxes will be increased to protect from landfills and The climate. It means it means imposing taxes on landfill and emission that could harm the environment and climate. These taxes are used in the USA. What about in Sri Lanka? Children, now we have come to an end of the lesson. As a summary, fiscal policy refers to a government's spending and taxation. And a government can use number of policy instruments to achieve its macroeconomic objectives. And also we learn how government intervene in the process of economy using variables as tools in the policy instrument. Fiscal deficit can be occurred when the government spend more and earn less, whereas the fiscal surpluses will have by the government with less spending and earning more through the taxation. And also we learn at the end of the lesson how the fiscal policy can be impact on macroeconomic objectives. So the government will use contractionary policy and expansionary policy in order to achieve macroeconomic objectives. Hope you could understand the lesson. If you could understand, you all can do these activities. Activity 1 at page 252, activity 2 at page 255, and there is a case study at page 257. Try your best. Children, here are some references. You all can use these link addresses and read more about fiscal policy. Thank you for listening, children. Stay safe.